Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. Thank you so much for joining. All right. If you're on YouTube, please like, please subscribe, please share with anyone you think might be interested. If you subscribe and hit the notifications bell, you get notifications of when we go live. We go live twice a day. This is our afternoon session. We were here earlier at 10 a.m. Pacific, 1 p.m. Eastern. Then we're back in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. So please chat over questions or topics you wish to discuss, as we love to talk about these topics, of course. We appreciate the opportunity. Now, tomorrow we'll be here with a deep dive session in the afternoon, specifically talking about mega backdoor Roth contribution strategies geared towards businesses that are taxed as a sole proprietor. So again, subscribe, you get the notifications. You can see that we go live twice a day. We've got a lot of content here in our channel. Another great resource is going to be our community. So let's take a look at our community real quick. So we have a forum. We have forums on there, for example, where people are posting questions in the forums 24/7. So it's a great way to also, you can see, for example, we got lots of forums. So it's a great way to ask questions, see what other people are asking. There's a library on there of videos and webinars. There's a lot of great resources. Now, today, we want to talk about solo 401k versus SEP IRA contribution limits explained. So that's the topic that we wanted to go over. Now, before we get started, though, just let you know, of course, the presentation is being provided for educational purposes only. Should not be construed as tax advice, legal advice, or investment advice. It's none of those things. We're here just to educate. And of course, we'd never discourage you from speaking to your tax advisors, your legal advisors, your investment advisors. So thank you so much again for taking the time to join. Now, before we jump in, we've got a question here. So let's knock out a question because we do want to encourage you to chat over questions. So it says here, for example, the employer Roth contribution must be reported as tax deductible on the employer's tax return for the year of the contribution and taxable to the employee for the year of the deposit. Can you explain this? Definitely. So one of the things that is now allowed thanks to the Secure Act 2.0. So this is major legislation in Congress, referred to as the Secure Act. They did a couple rounds of it. The most recent version, the most recent legislation allowed for contributions to be made, employer contributions to be made as Roth contributions. Historically, employer contributions were always made as pre-tax contributions, as tax-deductible contributions. Well, there's been a big shift in the legislation towards Rothification, right, to a lot of things that will encourage basically Roth contributions, ROTH, right, where the money is deposited on an after-tax basis, but you have that potential for tax-free growth. So under the Secure Act 2.0, employer contributions can now be made as Roth contributions. Now, when this was enacted, there was a lot of questions about how to report those employer contributions to be made as Roth contributions. Because again, historically, they were always made as pre-tax contributions, as tax deductible, right? So if they're now going to be Roth, they need to be made on an after-tax basis. So how is that going to work? So the IRS didn't answer that question until almost a year later after the law was enacted with IRS Notice 2024-2, where they clarify that employer contributions are still going to be reported as tax deductible. So it's still going to be a deductible expense on the employer's return. And now it's deductible for the year for which the contribution is made. So what that means, for example, in the context of a solo 401k, is that really the deadline to make contributions is the business tax return deadline, including extension. So there's a lot of solo 401k owners that are making contributions for 2024 here in 2025. So they might be making an employer contribution as a Roth contribution for 2024. So when we say that it's tax deductible on the employer's tax return for the year of the contribution, we mean that that's going to reduce the taxable income on the 2024 tax return, even though it's deposited in 2025. And then it goes on, the guidance goes on, because again, it still needs to be, that employer Roth contribution still needs to be contributed on an after-tax basis. So it's going to need to be taxable to the employee for the year of the deposit. That's how it becomes Roth, essentially, right? So that's where it goes to, okay, when is the money actually deposited? Well, if it was deposited in 2025, even though it was made for 2024, it's now going to be taxable to the employee for the year of the deposit. So the way that that happens is that a 1099-R is issued to that employee to report that taxable income. So effectively, the self-employed individual, if they make a 2024 employer Roth contribution in 2025, they're going to reduce their taxable income on their 2024 tax return because they're making a tax-deductible employer contribution that's reported on the 2024 tax return. But they're going to raise their income on their 2025 income statement or on their income tax return because that's the year in which the contribution is deposited. They're going to get that 1099-R that they're going to have to then add that income to their 1040 for 2025. Hopefully that makes sense. Now I want to get going with some of the content. Thank you so much for the good questions, though. Please don't hesitate to chat over more questions. Again, please like, please subscribe so you get the notifications of when we go live. We go live twice a day. So we wanted to talk about the solo 401k versus the SEP IRA, contribution limits explained. So let's start out with the visual. This is a printout from our online calculator. So what this visual shows us is how much more one can contribute. The scenario we got here is somebody that's age 45. Let's say their business is taxed as an S Corp. They have $100,000 of W-2 wages. How much can they contribute to the solo 401k? In this blue graph is showing the solo 401k, whereas this red bar is showing the simple and the green is showing the SEP. So you can see how much more the individual can contribute to the solo versus the SEP IRA. So why is that, right? What's the explanation? Well, it comes down to the fact that with a SEP IRA, you can only make employer contributions. For a business taxed as an S Corp, that's going to be 25% of those W-2 wages. That's why in this scenario with $100,000, the person could contribute $25,000 to the SEP IRA. And that's it, right? Whereas with the solo 401k, you have multiple buckets that you can fill up. You, of course, have that same employer bucket that applies to the SEP, but in addition, you can make employee contributions. Moreover, if you have a plan like ours that allows it, you can make voluntary after-tax contributions, which is not even covered by that bar graph, which are contributions that can end up in a Roth account. Voluntary after-tax contributions are how one makes mega backdoor Roth contributions. So from a contribution perspective, a solo 401k is much more powerful because you got more buckets you can fill up. Moreover, you can fill those buckets up faster, right? With the employer contribution, it's just a fraction of your income, right? So to justify a $25,000 employer contribution to the SEP IRA, that individual needs 4 times that amount in self-employment compensation. 4 times it of $25,000 is $100,000. Whereas with the solo 401k, you can first fill up that employee bucket, which for 2025, for example, is 100% of your wages, dollar for dollar, up to $23,500. And then additional contributions that can be made as catch-up contributions or even super catch-up contributions, depending on your age. If you're age 50 or older, you can do a catch-up contribution of $7,500 of that self-employment compensation. And then if you're age 60 to 63, you can make a super catch-up contribution. Instead of $7,500, it's $11,250. So you're going to be able to fill that employee bucket up right away, dollar for dollar. It's not a percentage, right? So you can quickly fill that up. And then on top of that, if you got the self-employment income to justify it, you can make additional employer contributions on top of that. So that's how you can end up contributing so much more. And then for those folks that are interested in making Roth contributions, yes, you can now make Roth contributions to a SEP IRA. That's a new thing, like the employer contributions to the solo 401k. But with a plan like ours that allows for mega backdoor Roth contributions, that's a big advantage for those that are focused on Roth, because you can't make mega backdoor Roth contributions to a SEP IRA. The only type of contribution you can make is that employer contribution, which is going to be a percentage of your income. Yes, it could be made as Roth, but if you have a plan like ours that allows it, you can make what are called voluntary after-tax contributions. And you can contribute 100% of your wages dollar for dollar up to the limit as a voluntary after-tax contribution. So for that same scenario where the person is age 45 and they have $100,000 of W-2 wages, if they were looking at making a Roth contributions to a SEP IRA, they're going to be capped out at $25,000. Whereas with our solo 401k plan, they could contribute up to $70,000 as a voluntary after-tax contribution and then move it over to a Roth solo 401k. So instead of $25,000 in a Roth, they're putting $70,000 into a Roth. And then, of course, you've got other advantages of the solo over the SEP. For example, the ability to take a loan, the ability to invest in alternative investments with checkbook control, the fact that our plan makes the self-employed business eligible to claim $1,500 in solo 401k tax credits, which is going to more than cover our fees for the first 7 years. So there's even more advantages in addition to those contribution advantages. So hopefully that gives us a good explanation of the differences between a solo 401k versus a SEP IRA. All right, so now let's keep going with the questions. Thank you so much for the great participation. All right, do contribution limits apply when considering rolling over an IRA into my solo 401k? I want to roll over $50,000 from traditional IRA, but my income limits the contribution to about $25,000. No, they don't apply. There's no limit on how much one can roll over to the solo 401k. As long as they're rolling over money from an eligible retirement account, right? A former employer plan, a non-Roth IRA, they can roll over as much or as little as they want. There's no limit. It's not, even though those funds, of course, are going to be deposited into the solo 401k, it's not considered a contribution. Therefore, it's not subject to the contribution limits. So that's a great vehicle for customers who might want to consolidate their funds. They may want to then turn around and invest those funds in alternative investments, whether it's real estate or crypto, et cetera. Maybe you want to use the money to justify taking a solo 401k loan. Now, as you might imagine, the process to transfer funds is going to vary based on institution. It's going to vary based on type of account that you're rolling over. So what's great about us is we've helped thousands and thousands of self-employed individuals roll over money to their solo 401k. We're very hands-on in helping them roll over money. And it's important that it's handled correctly because that transfer is going to be a reportable event. So it's going to be important, for example, in your case, that the traditional IRA provider understands that you're processing a direct rollover so that they report that to the IRS as a non-taxable direct rollover. So we'll get involved, for example, in preparing the transfer paperwork. And we've helped customers transfer funds from hundreds and hundreds of different places. And we've tracked that experience in our knowledge base so we can make it easy for existing customers or new customers going forward to transfer money from the same place. Great question. What if the employer Roth contribution and deposit are made in the same year? Great question. Well, in that case, it's going to be both. If it's contributed for the same year and deposited in that same year, so let's say they're making an employer Roth contribution in 2025, but for 2025, so it's both for 2025 and made in 2025, then it's going to be both deductible on the 2025 tax return as a business expense, right? Because it's an employer contribution. It's also going to be taxable to that employee in that same year. So it's going to be a wash in that year. Now, with this whole discussion around employer Roth contributions, I think it's noteworthy that in our experience, based on our client feedback and their experience, this was not really a big event for our customers when the law made. I mean, it's a big change, right? Because historically, those employer contributions were always made as pre-tax contributions, and now you can make them as Roth, right? So, like I said, we talked about there was a lot of confusion. Okay, how are we going to report this? But for our customers, it really wasn't a big change because they already had the ability to make mega backdoor Roth contributions. So for those customers that are trying to maximize the funds going into a Roth account, they're going to be able to more quickly, right, make contributions to that Roth account, kind of like our discussion around solo 401k versus SEP IRA, because that employer contribution limit is a percentage. They're going to need a multiple of the amount that they want to contribute as self-employment income to justify the contribution. Whereas the voluntary after-tax contribution limit is 100% of self-employment compensation. So for example, if you're under 50, as long as you have at least 70,000 of self-employment income for 2025, that individual can contribute 70,000 as an after-tax, right? Whereas if they're trying to make it as an employer Roth, it's just going to be a percentage of that income. So you're going to be able to more easily and more quickly hit your contribution goal. From a deadline perspective, the contribution deadlines are the same between after-tax contributions versus employer Roth contributions. So that's a wash. In terms of flexibility with those funds, you have more flexibility with the after-tax funds as opposed to employer Roth contributions. So what do I mean by that? Well, under the rules, the general rule is that one cannot transfer money out of a solo 401k, even if it's going to another retirement account, until they're age 59 and a half or older. But a big exception to that general rule are voluntary after-tax funds. So as long as the individual has a plan like ours that allows for those in-plan or in-service transfers of voluntary after-tax funds out of the solo 401k, they could make that voluntary after-tax contribution and then transfer the funds out to a Roth IRA. Whereas if you make an employer contribution to your Roth solo 401k account and then subsequently want to transfer the money out to a Roth IRA, you'd have to meet a triggering event before you could do that. For example, being age 59 and a half. So that flexibility is another reason that folks will prefer making contributions as after-tax contributions as opposed to making employer contributions as Roth contributions. And so that kind of goes to this question, I would say, is hopefully that helps shed light on that question. Great questions. Follow-up. Solo 401k does not require UBIT when investing in leveraged real estate, correct? So great point. So let's first explain. So UBIT refers to unrelated business income tax. It also refers to unrelated debt finance income tax. So they're in the same section of the manual, you could say, with the IRS guidance. Technically, they're different taxes, though. So unrelated debt finance income tax applies, like you use the same form, et cetera, to pay the tax. The unrelated debt finance income tax applies when you have a leveraged investment inside of a retirement account. So for example, real estate, right? If someone wants to use their retirement money together with debt to invest in real estate, it's possible to do that, provided that the debt is non-recourse financing. In other words, the lender's only recourse is the property, right? The solo 401k owner or the IRA account holder cannot personally guarantee that loan. The only recourse, again, if the loan is not paid back, is to foreclose on the property, right? So that means that those non-recourse lenders are going to price those non-recourse loans differently, right? They're a lot of times going to want 50% down, for example. Now, unrelated debt finance income tax generally applies when you have income from a leveraged investment inside of a retirement account. So let's say you're buying stock on margin, for example, inside of a retirement account. That means that your retirement account would be liable to pay that tax on that income from your leveraged investment. Doesn't mean that it's prohibited. It just means that you're not going to make as much money inside your retirement account. Now, there's a big exception, though, to that leverage, to that unrelated debt finance income tax that provides that if you have income inside your 401k that comes from real estate that's subject to acquisition indebtedness, so leverage real estate, unrelated debt finance income tax is not going to apply. Whereas if you had that same investment inside of an IRA, the IRA would be liable to pay that UDFI tax. Does your company do self-directed IRAs? No, we're not an IRA custodian, but we definitely facilitate IRA LLC transactions where someone will have their IRA invest in an LLC, and then that LLC makes an investment, say in an alternative investment. Most of our customers that are setting those up use a company called Forge Trust. You can find more information on our website. Let me just pull up the main page real quick. And you can find out more information about Forge from that main page. Thank you for the good question. I want to start a ROBS to buy an RV park. So that wouldn't be done through a self-directed IRA, just to be clear. So you can't use an IRA to fund a business. We were planning on managing the RV park for the first season and stay on the property. Would that be a prohibited activity? So it's definitely something where you have to be very careful, where, for example, the individual would not want to make the RV park their legal residence, right? They would need to be ready to show that, because when you use a ROBS to fund a business, the individual that's investing retirement money does need to work in the business, right? So certainly there are some businesses where you need someone to be on the property 24/7, like maybe an RV park to be able to handle requests from the customers, et cetera. So that might be the expectation in the market, right? If you don't have someone there, you're not going to have any customers, for example. So if the individual who's using their retirement money is going to work in that capacity, that's acceptable, but they would want to be certain that they don't make the RV park their legal residence. They want to be certain that they can show that that's a necessary function of the role that they're serving in. They would want to be able to demonstrate that the accommodations that they had were the same type of accommodations that would be given to any employee in that capacity. In other words, if the business hired an unrelated person, you may provide a certain level of accommodations, but it's not going to be a lavish level of accommodations, right? So that's the same level that the individual would have to be provided, the individual who's using the retirement money. Hopefully that sheds light. 100% of employee contributions can be Roth contributions. That's right. With our plan, they certainly can. And they would go directly into that Roth account. So for example, if the goal is to mega backdoor Roth and the Roth, let's say the individual has $100,000 of W-2 wages from their business taxes and S Corp. Let's say they didn't make any employee contributions to another plan, like a day job plan. Then they can contribute, for example, let's say they're under 50, 100% of their wages up to $23,500 as a Roth employee. Then they could do the difference up to $70,000 as an after tax, and then move the money from the after tax to the Roth. Got it. So yes, it's possible to convert a solo 401k to a ROBS 401k. Now, there are additional considerations. For example, if the individual has alternative investments, those alternative investments cannot be held in the ROBS. But feel free to book a call with us so we can go over the situation in more detail. mysolo401k.net/book. Thank you so much for joining. Appreciate the good questions. All right, well, it's been great questions so far. We really appreciate it. Does your firm have the IRA rollover form or my current IRA custodian? How long does it take to show up in my new solo 401k with your firm? Well, it's generally best to get the form directly from the IRA provider, even though we do have all that experience that we can leverage, because a lot of times they'll update the form and they don't publish it on their website. And then we just hate to have the form be submitted and they come back and say, well, the form's outdated. So now you got to resubmit the form, the new form. But certainly get the form forwarded to us and we'll help complete it. Awesome. Well, this has been great. We'll give you another minute to see if there's any more questions. Like I said, please don't hesitate to participate in our forums and our community. Please like, please subscribe so you can get notifications. We'll be back tomorrow at 10 a.m. Pacific, 1 p.m. Eastern, and then back again in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. We always appreciate the chance to discuss these topics. Oh, yeah, let me send over the link to the pricing page. One second. If you just go to mysolo401k.net under 401k business financing, you can easily find it here. Just under, there's just right there, pricing. There it is. It's under pricing. So when I move the contribution from the voluntary after-tax account to the Roth account, do I just contact the brokerage for help with that transaction? Let me pull up our procedure page. You're also going to want to let us know about that move because that's going to be reportable on a 1099-R. And we handle that 1099-R as an optional free service for our customers. Customers just submit an online form to give us the information we need to prepare the 1099-R. But this procedure page goes over all the steps, including the move that you're talking about. All right, until next time, everyone. Thank you so much.